even though a lot of investing across these different sectors is down, it does seem that VCs are now more open to non-software businesses. So atoms, building in atoms instead of building in bits, hardware, biotech, energy, these places that could have real outsized impact on the general economy beyond just tech. I think that there's been a little bit of a turn back towards, well, if SaaS isn't going to return 30x to us, then we might as well take a better look at some of these more capital intensive industries, which I think is just a net good for humanity overall.
Welcome to the Founders Journey podcast. Inspiration, education for founders by founders. Welcome back to the Founders Journey podcast. Glad to be back, Peter. Week before Christmas, 2 weeks before Christmas.
I'm excited. You didn't wear the new T-shirt I got you.
I did not. I actually, you know what? I had a bright red velvet sport coat in the other room, and I forgot to put it on. So
I'm already disappointed.
I don't blame you. So we've got two Peters today on the call. So we'll do our best to sort them out. But yeah, glad to have Peter Walker with us today. So Peter is a guy that I was just telling him before we started recording. I've been following him he's famous or infamous, whatever. On LinkedIn. I've been a big fan of following his work. Peter runs the insights team at Carta, which we're going to explain. I think a lot of founders listening are going to know Carta. I have about 27 Carta accounts right now from all, from various companies I've invested in and things.
Nice.
But Peter's work is really around really looking for within the data, the key narratives around the private market ecosystem, VC, PE, things like that. Before that, he was head of marketing for a media analytics company. And before that, this is actually pretty cool. I didn't catch this, but a lot of us sort of lived on the COVID tracking project for about a year of our lives. And Peter was the guy putting out that data visualization that a lot of us were going there religiously every single day. So really super interesting stuff. And he's got a new puppy. A new corgi puppy and lives in San Francisco. So that's probably the most important part of it. But Peter Walker, welcome to the podcast.
Hey, thanks so much. Happy to be here, Greg. And yes, you hit on the most important part last, proud puppy father. So nothing more to say there.
That's right. I don't think we'll have time. If we have time, I'd love to just kind of hear about the genesis of the COVID tracking project. I mean, it's just a super cool thing. And it was really in putting together your bio. I was like, wow, I had no idea, but so many of us lived on that. But tell us, I mean, just kind of start from the top, right? How did you,
Sure.
You're deep into data visualization, data analytics. How did you get into this? And how did you kind of start down that COVID tracking and over to Carta kind of path?
It was just a series of serendipitous events, honestly. I was working at this media intelligence startup back east in DC called Public Relay. And I got joined just out of school. It was probably employee number, 11, 13, something like that. And at that size of a startup, as soon as you prove that you're mildly competent, you just get flooded with work, no matter what that work is, or if it has anything to do with the things you studied in school or are good at. And I just kind of found myself gravitating. At first I was an analyst, and then I built a data analytics team there, focusing on Tableau and Sisense and a couple other platforms. And then I kind of got burnt out of data for a little bit, went over to the marketing side. And so my background is this sort of, I'd say, rather unique mix of product marketing and data. And combining those two, as you mentioned, I got a chance to do that at the COVID tracking project, which was, certainly the most noble work I've ever done. And it just kind of opened my eyes to the idea that a lot of organizations, companies and otherwise, are sitting on this data. And there's usually a sense within the business that this data is incredibly valuable and we need to be very careful with it. And we should monetize it, if anything, but we should keep it to ourselves, because data is quote unquote the new oil, right? We don't want to just be giving it away. When my general view is that it's completely the opposite, and that you would gain far more as an organization putting this data out into the world and educating your ecosystem on what's important about it than you do by hiding it or selling a PDF or something like that. And luckily the people at Carta, agreed with that general worldview, and then I got to come on and build this practice here.
So talk about a little bit what you're doing at Carta specifically, because I know
Sure.
Carta in the PE VC world, and whether you're on the company side or you're on the investor side, and I've been on both,
Yep.
Carta is ubiquitous, right? It
Yep.
is the go-to source. Talk about
Right.
what you're doing for founders and kind of what your role within using those analytics, because it is the private market source.
Definitely. So I think you touched on one of the most important points, which is when I had come on to Carta, Carta had already achieved this level of market share and ubiquity that allowed us to take a look at the data that we had access to and to say something I think pretty meaningful about the market as a whole. Now, it's not to say that every startup in the US uses Carta or every VC fund does, but enough of them do. Our market share is strong enough that the analytics that we can put out just from our companies I think speak really well to the overall trends in the marketplace. So when I came onto Carta, the general tagline for my role is make Carta data more useful. And that can take a lot of different forms. The ones that are probably the primary ones that you interact with are, we put out a ton of graphics on LinkedIn and other social platforms, just little snippets of important things for founders to know. What are safe valuation caps these days? How should you treat equity for your earliest employees versus your later employees? How much should you compensate an advisor in equity? All these questions that we get constantly from founders. We have the data to answer it, so we should go and answer it, and we should answer it in public, and then other people can cite us as a source of truth. We also then build a business like a deeper insights function, bigger reports on the state of the market, deep dives into special topics. We have a Data Minute newsletter that's about 20,000 subscribers strong this year. And we've got a whole lot of ideas about how to continue to put Carta data into the ecosystem. It's funny that you use the word ubiquitous. My goal at Carta now is to make Carta data ubiquitous and to have us be the source of truth for VC and startups in the US. Luckily we get to play in this space, and we're not selling a lot of this data. So we sort of, I wouldn't say we compete with places like PitchBook and CB Insights. It's more of a co-opetition model, I would say. But we're not making money on any of this data. We just think it's useful for us to be a source of truth in the ecosystem.
The newsletter is Carta Minute. That's the name of it, right?
Yeah, Carta
And
Data Minute. Yep.
Carta Data Minute. Yeah, it's awesome. If you don't subscribe to it and you're listening to this, do it. If you're in this
Thank
world,
you.
it really is a great piece. I follow it pretty closely.
Yeah, and the importance of getting that benchmark data for a founder, because
Yeah,
there's some founders that have done it before. There's a lot of founders that haven't done it before.
Yep.
And they're trying to get this information. They're trying to understand, are we doing this right? Are we following the right process? Does this make sense? That is so valuable to
Yeah.
a founder, because we just don't know. Like, it's not what
Yeah.
you do every day. You do the other stuff. You build the product. You do all that. So that's really important. And we really appreciate you guys sharing that.
The point there too is that if you're a first-time founder and you're looking for this information, oftentimes the only people that can give you a sense of just beyond anecdotes or the last couple people you talk to are your VCs and your lawyers. And let's be honest, that can be an adversarial relationship where you're not always aligned on these things. So it's
Right.
we think we can provide this sort of baseline source of truth that's at least more independent than the other places that you might be getting this information from.
A real healthy way to preserve that relationship in a way that you can bring something up with the benchmark that you have a conversation around, instead of maybe being led down some road that's maybe not a good place to be.
Exactly.
That's really good.
Yeah.
How would you characterize the state of the startup economy today? Like, how would you characterize that?
I think it would be difficult to use any glowing words here.
Yeah.
It's, I think the obvious headlines are we're way down from where we were in 2020 and 2021. The boom is over. Startups are now focused on being capital efficient businesses, et cetera, et cetera. And generally speaking, fundraising is just harder for everyone. I think that is a true headline as far as it goes, but I think it actually kind of hides some of the nuance in this market. And the major nuance that we're seeing is that there's starting to be a bit of a barbell market where founders without connections, first-time founders, are having to show a lot more traction in order to raise any capital than they used to.
Yes.
And
Yep.
second-time highly networked founders are raising like it's 2021.
Mhm.
And it's like the gap between those two groups of people, I think has widened more in the last 18 months than we've seen it in quite some time.
Are you seeing that in certain segments, or is it in all
Mm.
segments? Is it all?
I'd say it's in all segments. I mean, if you take a look at the fundraising data that we have, it's true that later stage has been hit more than early stage, although everything is down from 21. Uh, I think that the way that we talk about it internally is that it's actually a pretty good time to start a company, but
Yes.
it's a pretty difficult time to grow one. And so the founders who perhaps they started their company in, say, let's say 2019, and they raised a seed round, or maybe they even got to a Series A by the time early 2022 happened, they grew up, their formative startup experiences were in a completely different macro economy. Interest
Yeah.
rates were zero, money was free, all of these things. Everyone was super excited about startups or crypto or whatever. And now they have to whiplash change to this new world. Whereas the founders that are starting right now, they're growing up in the difficult conditions, and then it's actually easier than having to change track in the middle of your startup growth.
Yeah. There's a lot to that, right? I started my last company in 2008. We literally incorporated the day that Lehman went under,
Wow.
right? And
Yeah.
there really is something to that. When
Yeah.
you start kind of at that very bottom, when you don't know what the good days look like, your good
Right.
days are actually pretty dismal, right? You
Right.
just don't know
Yeah.
it, so they're fine. And
Right.
but it's the reverse, and you see this all the time. We see this in portfolio companies that we talk to, or in that, when you grew up like in your infancy at that peak, right? You now are in this situation where the amount of time it takes most companies to react to this kind of change
Hmm.
is enormous,
Yeah.
right? Because everyone believes that the good days are right there again. And it's not so much that they're bad days, it's just that we're kind of reverting to what is kind of more a normal state,
Yeah.
right? I mean,
Yeah.
would you agree with that, or is that
I think I think a lot of people have said this is a quote unquote, like we're getting back to a healthier ecosystem or a more
right?
realistic one, at least.
Mhm.
And I think, again, that is definitely true. I don't think it was sustainable at all for valuations to go up and to the right and skyrocket
Right.
the way that they had been and all this cash and stuff. I do want to be careful to not then make the second claim that this is like morally good. Um, like
Right.
Right.
it's
I don't.
still an incredibly difficult
Yeah.
time for a bunch of founders. And sometimes you read all these comments online, and people are like, well, all these founders were just trying to take advantage of zero interest rates, and they probably didn't even believe in their businesses. And I just don't think that's true. I think most of the
No.
time, most every founder believes they're building a generational company, and they're just doing it in the water, quote unquote, that they get to swim in every day. And if that
Mhm.
water is zero interest rates and free money, that's great. And so they're going
Right.
to build differently. The biggest thing that I think has happened this year, which again, I'm sure that all the founders listening have heard before, is that there's just been this quote unquote renewed focus on profitability, unit economics, capital
Yep.
efficiency, whatever you want to call it. The thing that I don't have a good idea or prediction on for next year is, okay, we've been through 12 months where the focus was on capital efficiency, but in the end, venture is a growth business. Like VC depends on growth.
Mhm.
And when will the message start flipping back to growth is the most important factor for these new rounds? Because when we talk to founders, honestly, some of them are like, look, I made a lot of changes to my business. I became a lot more capital efficient. But now some of the VCs that I might have raised my next round from are telling me I'm not growing fast enough. And it's like,
Right.
did I get the balance right? Or is there a way that I can, hold both of these ideas at one time
Yeah.
in the same company? And that's really hard for a lot of founders.
Do you think there's like this big pendulum swing that's now got to come back a little bit? It's kind of what you're talking about.
I do. And I do think that there's been, we've all seen there's been a ton of layoffs across private tech, just like there was in big tech and all,
Mhm.
et cetera. So I do think that I don't expect us to get back to the heyday of 2021 in
Right.
terms of employee counts and all that kind of stuff anytime soon. But I'd be shocked if at some point in 2024, the message didn't swing back to like growth is like you want to focus on growth again. At least perhaps not to the detriment of unit economics, but growth is the primary focus.
Yeah, I think one of the things, Peter, is you end up, and I know you look at this because I've been on both sides of this, right? I've been an operator in good markets and bad, and I've been an investor in good markets and bad.
Mhm.
And it is a completely schizophrenic market, right? Where you sit there and on one hand, you're saying to a founder, cut expenses, get lean,
Yep.
I don't, just hold your position,
Right.
right? And and it's important, and you need to do that because the basis of that is don't run out of cash, right? Because
Right.
you won't live to fight in the good days.
Definitely.
But it is a brutally difficult thing for both sides to get that balance right because you're absolutely right. Without growth, nothing no,
Right.
nothing is going to occur.
'Cause-
Nobody's going to get a return on this investment, right? So
100%.
finding that balance and it's so easy, like Peter Dean said. I mean, it's so easy to, that pendulum swings all over the place. And for a
Yeah.
founder, it's like, look, guys, I don't know what in the hell you want me to do.
Right. Yeah.
Right.
Yeah. Give me some clear direction here, you know?
That's
Yeah.
right. But
Yeah.
it's because the market's not clear, right? And that's the thing.
100%.
Everyone kind of responds to what's in front of them. And when you don't know how long that kind of interest rate environment's going to last, or you don't know, if something breaks in Ukraine or something like you
Yeah.
just when you have that much uncertainty, everyone kind of sits there and says, just hold,
Totally.
right?
Totally.
And so I mean, kind of fast forward a little bit, like where do you see this? I mean, and you alluded to this a little bit, but how do you expect these trends to start to play out in 24? Things start to loosen, that pendulum starts to swing a little bit?
I think the thing that I am really looking at, which is certainly, I'm not alone in this, is when do IPOs come back? It
Hmm.
is I think it is an underreported aspect of the venture ecosystem, just
Yep.
how much of a cap the lack of IPOs puts on the entire market. It is,
Yep.
it is like the price discovery mechanism for these late stage companies. And if
Mhm.
without that, the late stage private investment marketplace cannot by definition be healthy. There's just like
Right.
there's not enough of information to know whether or not you're building towards something that will eventually be an exit that your investors can be happy about. So IPOs, when are those coming back? And even within the IPO market, I think that there's we had Klaviyo and a couple others this year. They did middlingly well or not that
Hmm.
good, depending on who you asked. I think that there's also an underrated aspect of like certain names coming out of the private tech ecosystem and going public will have a much bigger impact than others. Not to
Hmm.
downgrade anybody's business here, but like as an example, if Stripe goes public in 2024, that will be a huge deal.
Hmm.
I'm not predicting that they will. I can see it from both sides, but like we kind of need that like rallying cry, that moment where it's
Yeah.
like, okay, we're back. Like let's to take a
Right.
joke from Elon's social network these days. Like we're so back if Stripe goes
Right.
public. Um,
Right.
the other part of the market that I think is going to be hard to deal with, and you use the word schizophrenic, and I think that's actually a pretty good word. The way that I've been thinking about it is like a dichotomy. I do think that fundraising is going to get marginally easier, or there's going to be more cash flowing into VC next year, at least
Hmm.
invested into companies. And simultaneously, there's going to be a lot of startups shutting down. And so it's
Hmm.
going to feel like this very bifurcated market of you'll read about big AI rounds, and then you'll read about all the startups going out of business, and you maybe read them in the same TechCrunch article.
Mhm.
And it's just going to feel very, very all over the place.
Is this
Yeah.
the hangover from the past valuations that we had and investing maybe a little frothy in areas, and now we have some really good fundamental new stuff coming that is like the future? Is that kind of
Yeah.
what you're seeing?
Exactly. Well said. And I do think that there has been an increased recognition on the part of founders and investors that valuations in 2021 got out of hand.
Yeah.
Where, down rounds on Carta, it's like 20% or so of all the rounds on Carta that happened in 2023 have been down rounds. That's the highest percentage
Yes.
in our
Yeah.
entire history.
It's insane.
Yep.
In some ways, I view that as a silver lining. That's people
Mhm.
getting into a room and saying, instead of forcing all this structured terms on you and these high liquidation preferences, let's all do a down round. Let's admit that we got this wrong and
Move
let's
forward.
continue building.
Yeah.
And
Yep.
I love that for founders and investors, but that's still only 20% of rounds. So like
Yeah.
you're not going to, there are still, even though it feels like 21 is a long way away, there are still companies out there who have done everything they can not to go back to the fundraising markets and just not to get revalued.
Yeah.
And at some point, they're going to have to.
They're going to run out of runway.
They're
The
going to run out of
runways-
runway.
It's
You can
almost,
only slash so much, right?
Yeah.
Like, yeah, at some point
then
you
you-
start hitting bone.
to Greg's point, then there's no growth. Then what do you have? Like,
Right,
if you
exactly.
just like crammed it down so far, you went from like lots of potential to maybe like, is this real? Is there something good here?
Yeah. Not to say that there isn't a lot of business models out there. I don't know what percentage of
Yeah.
startups fall into this category, but there are a lot of startups for whom the way they went to market and made money in 2021 is just no longer available. Like
Right.
that sort of growth is just not available to them. Maybe they'll get bought, maybe they'll add new features that are a different kind of thing, but there are some of them that are just like they don't make sense in this new world.
Mm-hmm.
That happens.
Yep.
Yeah.
Yeah, for sure. One of the things that I've had a lot of conversations with founders about is this. I mean, this real aversion, and I get it.
Mm,
I had a down round before. It's not fun.
yeah,
It's also not the end of the world, right?
totally.
And it is one of those things that, okay, it's kind of part of the journey sometimes, right? And
Sure.
it's not, and especially when you're looking at a lot of these startups, I mean, these are 10-year cycles in a
Yep.
lot of cases. You're gonna have things. We don't normally have a 10-year boom cycle, right? We just
Yep.
did, but we don't normally.
Right.
We're gonna have these cycles, and there are going to be times when a down round just simply makes sense. It makes sense for everybody, investor and founder. So just take it, take it and move forward, right?
Seconded for sure. And the one thing that I'll say, which is not true across all founders who've taken down rounds, but I think some of the best ones have done this. When you're, part of the reason why a down round is so scary or has the stigma is that you're not only saying to the world, hey, we got this thing wrong. You have to talk to your own employees and be like, hey,
Right.
you may have joined in 2020 and 2021 and your equity is not worth what you thought it might have been worth. And that was, to some greater or lesser degree, one of the biggest reasons why you joined this company. So you could have upside in the equity outcomes.
Yep.
We have seen companies do repricings on equity, not candidly, not a lot, not nearly as many as who've taken down rounds, that's for sure. So just making sure that founders know, hey, this affects your employees as deeply as it affects you, and you want to be open and upfront with them about what this means for their equity.
So that's actually a really good segue into a
Mhm.
question we had for you, which is, if you're an employee today,
Yeah.
how are you feeling about the startup economy?
You're asking for cash over equity, and whenever you
Right.
can, that's for sure.
Yep.
I think that you're following the same sort of cycle where startups were the hottest thing to do in 2019, 2020, 2021. You may have joined with the promise of a rocket ship. You may have joined a unicorn that is now underwater because your equity got revalued. There's a whole host of reasons. Hopefully, the view on startups is that you're not joining solely for the chance to become a millionaire with this equity, because frankly, those outcomes are pretty rare. You're
Hmm.
joining because you believe in the mission. You get all this responsibility. Like back to my first company out of college, being that junior or that, only, 10 to 20 of us, you just have so much more responsibility. You just get to do
Right.
things that you wouldn't get to do at a big company, and that can set you up for success. I will say that when we talk to startup employees or where we help compensation questions around startup employees today, they're very focused on, you know, what is the strike price of this equity? Does it make sense for my long-term package? They're asking for cash, as I mentioned, whenever
Hmm.
possible. But they candidly don't have a ton of leverage at the moment.
Right.
Hiring across startups is definitely nowhere near as roiled or boiling as it was in 21. So it's very likely that if if you were going out at that point, you might have had 2, 3, 4 job offers. Now you probably have one, and negotiating on that one is harder. So it is a more difficult market for employees as well.
Yeah. 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 No, I mean, that's certainly, consistent with the experience that, we see all the time, right? It's,
Yeah.
there just aren't nearly as many opportunities. And when you don't have as many opportunities, it's, one of the things that, we've talked about with, in a lot of our companies is, and you experience this, right?
Mm,
That early stage of a company, when you can get in there as an employee to your exactly the experience you shared, and this was my experience, right? I At a really early stage, I got involved in a company that really took off.
yep.
And the thing I think that employees and startups really need to remember is, yes, I mean, maybe you'll make some money on the equity. The best advice I've ever heard on the stock option piece is, great, take the piece of paper the day you get it, stick it in a drawer, and don't open that drawer again. And
For sure. Yeah.
because you just have no idea, right? But the real value in it is
Well, I mean,
you
hopefully,
can
by the way, you are not getting actual pieces of paper and you get it on Carta, but we'll leave that aside. Yeah.
right, exactly.
Yeah.
Just lose your login. Like
I
I
mean, like
do
I'd be kind of
20.
worried if you were actually getting some actual stock certificates on paper these days, but
I have no
fair point.
I have no paper. No.
Greg,
Yeah.
why did you send me this stock? Like, why am I getting these?
That's right. I do send it to you, Peter.
Right.
Dean. I write for my companies. I just write it in crayon, paid to
Yeah.
the order of Peter Dean.
For sure.
But
And that's still like, that works, right? I'm good. Those are good.
you're good. You're good.
Legal
You're fine.
legal
Don't worry.
tender. Legal
That's
tender
right.
for
You
sure.
know, you don't need to worry about it. So, but the thing is, I mean, you can build your career. Your entire career can be based
Yeah.
on those experiences, right? Whether you
Totally.
make money or not,
Totally.
that those experiences can be so extraordinary. We've got a lot of listeners, and I'm super curious about this. A lot of my portfolio is actually outside the United States today.
Yeah.
And
Yeah.
we've got a lot of listeners outside of the US today. You wrote recently about the valuation disparities between the US and particularly Europe, right?
Yeah.
Can you talk about that a little bit and what you're seeing there?
Yeah, so I guess there's two sort of different valuation types that we can talk about here. On the preferred valuation, the company is worth X million dollars, the post money, the thing that you're usually talking about. What we've seen, and Carta is, to take a step back, a US dominated business, but we have companies across the globe: Canada,
Mhm.
Israel, the UK, Singapore, all over the place. We acquired a Carta for Europe called Capdesk in 2021. They're fantastic. So we do have some data on how things are going there. I would say that most of the time, the trend begins in the US and it ripples outward to the other
Yep.
markets. Europe in particular, the valuations are down just like they are here. I think the chart that I was maybe putting out there most recently is just, if you're an employee, this is good for you to know. In the US, the system of 409A valuations basically is the independent arbiter of what your strike price will be. And you can just think of it as the price per share of your private company stock. And that's the thing that you'll have to pay in order to exercise your stock options. In Europe, there's a whole lot of different regimes about how this gets done. Some more favorable. In some cases, the UK is actually more favorable than the US. In some cases, France, Germany, other places, the strike price, what you end up paying, is much, much closer to what the investors actually are also paying. And so
Right.
if you're an employee, you want that delta to be rather large. You're taking a lot of risk, even at a Series A company, and you want to be able to have more upside in your equity. So it's just a kind of a call for employees across the startup ecosystem globally to really take a moment and deeply understand, what's the strike price on my equity? How does it become real? What's the likelihood that I'll ever see any liquidity from this? You want to make some good personal financial decisions and not just be kind of blinded by the idea, up and to the right, this is going to be a rocket ship.
Yep. I think that's great advice.
Yeah, that's
Spoken
good.
as the guy who hopes that you exercise your equity, obviously.
Yeah,
Totally.
absolutely.
Yeah.
So I have a question. We've interviewed a number of female founders and more diverse founders. What are you seeing as far as funding goes in that environment? Because the data really hasn't been that great for if you're female owned or if you're equity minority or
Yeah. It's probably the most depressing, dispiriting, saddest part of this year is that we just put out this report called the Carta Equity Report, which we do every year. And it's just a general look at who receives funding by founder, gender, race, ethnicity, and then who receives equity and how much equity for all the startup employees on Carta, again, by those demographic categories. And it's just there's not a ton of hope or good data points to point to. The amount of funding that goes to women only founder teams fell this year. The amount of funding that goes to Black and Hispanic founders fell this year. And it's sort of we had been making just incremental tiny bits of progress in the last couple of years. And then the downturn hit, and it seems, we don't know exactly why this is happening, but to me, it seems pretty obvious that what happened was, in the downturn, people just retreated to what they knew. So you're far more likely to make an investment for a warm intro or someone that's already in your network. And if you're giving more time and attention to repeat founders, well, who were the founders 5 years ago that could be repeat now? They're more likely to have been white, male, etc. So
Mhm.
I just think that the downturn has not been fun for anybody, but it was a sad year for the amount of cash going to underrepresented or female founders for sure.
Well, super glad we could end on a high note, Peter. Good to have you.
That's what I'm here for. Just adding a little bit of dismal to your day, you know?
No, I mean, it really is an important thing. And I think it goes back to the barbell comment you made before, right? Which
Yeah.
is, I mean, where do you invest when you have this much uncertainty? You start to invest around,
Yeah.
with people, and unfortunately those people, look the same exact way as, what has happened and you see that
Yeah.
kind of retreat. And I think, um, it's a super unfortunate outcome. You see it in a lot of ways in the economy, but it's definitely a super unfortunate outcome here.
Totally.
So to kind of wrap it up, and I'm really curious. I was kidding about ending on a down note. I want to end up, on a high note. If you're a founder,
Sure.
right, you're kind of looking at all this. You're looking at this kind of sea of data.
Yeah.
If you're a founder, what are the green shoots? Where's the optimism that you look at in the data and say, that's where I think this goes, or that's what I'm really starting to feel good about?
I think there definitely are uh, bits and pieces of optimism across the ecosystem. So the one optimistic story that everyone has spoken about this year is AI, obviously.
Sure.
It is a massive increase in AI funding. A lot of that is going to San Francisco companies, at least in the States.
Mhm.
But if you are building an AI or building, I think what will happen over the next year or two will stop being that AI is like the first thing that you say on your pitch deck, and it will start being that AI is just infused into the business,
Mhm.
and
Right.
investors are sort of just expecting that. So definitely some hope there. The other part that I thought was relatively hopeful, at least in my view, even though a lot of investing across these different sectors is down, it does seem that VCs are now more open to non-software businesses. So
Uh-huh.
building in atoms instead of building in bits,
Mhm.
hardware, biotech, energy, these
Mhm.
places that could have real outsized impact on the general economy beyond just tech. I think that there's been a little bit of a turn back towards, well, if SaaS isn't going to return 30x to us, then we might as well take a better look at some of these more capital intensive industries, which I think is just a net good for humanity overall. If we have young, ambitious founders who are building in energy, hardware, biotech,
Mhm.
nanotech, that kind of stuff, as opposed to just, hey, I'm going to make another wonderful sales tool.
Like build a really good company and you can get funded. That's what you said in the beginning. You're like,
Yeah.
really good fundamental early stage is not a bad place now, right?
Yeah. It's definitely the case that we have seen more companies get funded in more places, even this year, than we have in past years. Like it is no longer a requirement that you be in Silicon Valley in order to have an opportunity to fund these businesses. It may be that you can't be everywhere at the later stages,
Right.
but to get something off the ground, like you can do that from wherever you are with the people that you trust. And hopefully you can build a business that has real traction before you ever need VC funding. Like that's one of the biggest things for me coming up this year is how much VC funding will these new companies need?
Yeah.
And are there going to be more MailChimps that bootstrap to a $10 billion exit?
Yep.
I could see that definitely happening. We haven't seen too many of those exits yet, but in this new world with AI and capital efficiency, like maybe that's the outcome that we can hope for.
I think it's a great point. And you have to be able to see that, right? You have to be able to see that more of that bootstrapping really starts to occur. I mean,
Yeah.
we interviewed a founder just a couple weeks ago, Ben Wright, founder of Velocity Global. You may have heard of those guys, but they're
Mhm.
really large.
Yep.
Bootstrapped to over 100 million. I mean,
Yeah.
it's, was the story there. And you do start to see that. And I think that's what this kind of downturn, if there is good in this sort of breakpoint, not, this is a hard message, I think, for a lot of companies to receive. Not every company, very small amount of companies should actually ever get VC funding.
Totally
And
agree.
one of the problems that I think we were seeing was that so many companies were getting VC funding that should not have gotten it because there was so much capital that had to get deployed. So you
Yep.
start putting it everywhere. And what you end up with is, instead of 3% or 5% of startups, I think it's like three, right? 2 or
Yeah.
3%
Yeah.
actually
Yep.
historically. I mean, you ended up with this huge number, right? And
Yeah.
and it's not healthy. And what it does is it can take really good businesses that with some more creativity or with some debt or with some early stage angel, just angels and friends and family stuff could have bootstrapped themselves through this. And instead, now they've got this enormous pressure to grow, 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 grow. Now cut, and do all the
Yep.
schizophrenic things that we talked about, right? And
I, yeah.
and it kills
It's
a good company.
it has killed many good companies, and I do think that if there were one point that I'd advocate for founders is that you got to take a really long look at whether or not VC makes sense for your business. Not just could I raise VC, but once I raise VC, what hamster wheel am I on, and is that the right
Right.
wheel for me? And like there's I agree that maybe this downturn, one of the silver linings is that more founders are perking their heads up and saying, I know I want to be a founder, but that doesn't necessarily mean I need to be VC backed. And what are the other ways that I can fundraise or grow in order to build the business that I want to build?
That's right. That's right. And that will be a net positive coming out of this. You will see more
Yes.
solid, sustainable businesses that will come out of this
Yep.
because they're going to have to find a way, right?
Yep.
And because you're not going to stop a founder,
Yep.
right, who's on a mission to go do something. You may just
Right.
have to give them another path, and that I think is really the true silver lining. So,
Yep.
Peter, this is awesome. The work that you guys are doing. Is really phenomenal. Follow Peter on LinkedIn. You'll be glad you did. We'll make
Thank you.
him more famous than he already doesn't think he is. Um, and subscribe to the Carta Data Minute. And it really they're just doing an incredible amount of work. And if you're a founder trying to really understand what's going on out there, whether he said like, what's the difference between a safe and convertible debt, and
Yep.
what are all these things, they're the go-to source of information. So, Peter, what you guys are doing is awesome. It's really appreciated, and it's certainly appreciated to have you on today.
Yeah. Had a lot of fun, guys. I appreciate the invite.
Awesome. Well, we'd love to do it again at some point in the future. Once we see this, when we see the market start to turn, it'll be super fun to get you back here and give a more up to the minute update when we see that kind of that turn happening. So, Peter Walker, thanks so much for being on the Founders Journey podcast.
Thank you so much.